Hello everyone, welcome to Finance Currency, and what an incredible time to be alive if you're holding silver. Silver has officially crossed the $95 an ounce mark and is now knocking on the door of $100 per ounce as I'm recording this video on January 28th, 2026. And if you've been following this channel for any length of time, you know that I've been talking about this moment for years. But here's the thing that nobody is talking about right now. How much time do we actually have left in this silver bull market? And more importantly, what happens after the inevitable crash that every bull market eventually experiences? Now, I know that word crash might scare some of you, but if you watch this video until the end, I promise you that what I'm about to share will not only calm your nerves, but will also prepare you for what's coming next. Because understanding the timeline of this bull market and knowing what happens after the top is what separates the investors who build generational wealth from the investors who end up holding bags at the top. So let me start by giving you the current state of affairs. Silver is up over 280% from its 2020 lows of around $12 an ounce. It has officially broken through every major resistance level that analysts said would never be broken. And as of this week, silver has gained more in the last 18 months than the S&P 500 has gained in the last 5 years when you exclude dividends from that calculation. This is not normal. This is not a small move. This is a generational wealth transfer happening right in front of our eyes. But here's what you need to understand. Every bull market, and I mean every single one in recorded history, eventually comes to an end. The question is not if silver will pull back. The question is when and from what level. And that's exactly what I'm going to break down for you in this video. Now, to understand how much time we have left, we first need to look at historical precedents. Because as I always say on this channel, history doesn't repeat itself exactly, but it rhymes. And when we look at the last two major silver bull markets, we can see some very clear patterns emerging. Let's start with the 1970s bull market. Silver went from around $1.50 per ounce in 1970 to nearly $50 per ounce in January 1980. That's a gain of over 200% over a 10-year period. But here's the key insight. The majority of those gains, listen to this carefully, the majority of those gains happened in the final 18 months of that bull market. From mid-1978 to January 1980, silver went from around $5 an ounce to $50 an ounce. That's a 10x move in just 18 months after spending 8 years grinding higher slowly. Now let's look at the 2000s bull market. Silver bottomed around $4.50 per ounce in 2001 and ran all the way up to nearly $50 per ounce in April 2011. Again, roughly a 10-year bull market. And again, the majority of the gains happened in the final phase. From late 2008 to April 2011, silver went from around $9 an ounce to $50 an ounce. That's more than a 5x move in less than 3 years. Do you see the pattern here? Both major silver bull markets lasted approximately 10 years, and in both cases, the explosive moves that everyone remembers happened in the final 18 to 36 months of those bull markets. This is crucial information for understanding where we are today. Now, if we apply this same logic to the current bull market, which I believe started in late 2018 when silver bottomed around $14 per ounce, we can start to get a picture of how much time we have left. If this bull market follows the same 10-year pattern as the previous two, it suggests we could see this bull market continue until 2028 or even 2029. That gives us potentially 2 to 3 more years of upside from current levels. But here's where it gets really interesting. If the final explosive phase of this bull market is anything like what we saw in 1979 or 2010 and 2011, we could see silver move from current levels around $95 to well over $200 or even $300 per ounce before this is all said and done. And I'm not just pulling these numbers out of thin air. I'll show you the exact math and the exact indicators I'm using to arrive at these price targets later in this video. But first, I want to address the elephant in the room. What about the crash? Because if you were holding silver in 1980 or 2011, you know exactly what I'm talking about. In 1980, silver crashed from $50 to under $11 in just 2 months. That's a 78% decline in 60 days. In 2011, silver crashed from $50 to under $14 by 2015. That's a 72% decline over about 4 years. These crashes destroyed investors who didn't understand the cycle. These crashes created generational regret for people who bought at the top without a plan. And these crashes are exactly what I want to prepare you for today. Because while I believe we still have significant upside left in this bull market, I also believe that understanding what comes after the top is just as important as riding the bull market up. So in this video, I'm going to cover exactly how much time I think we have left based on 4 key indicators that have historically marked the top of every silver bull market. I'm going to tell you the specific price levels I'm watching for silver's potential peak. I'm going to explain what typically happens after a silver bull market ends and why this time might actually be different in one very important way. And finally, I'm going to share my strategy for what I plan to do when the top finally arrives. Just before we dive deeper into this analysis, please remember to check out the link in the description below for competitive prices on physical silver. Whether you're looking for 10-ounce bars or fractional silver products, you'll find great options there with new customers getting special pricing on starter packs. And remember, if you're not holding physical metal in your own possession, you don't truly own it. Link is in the video description below. All right, let's get into the meat of this analysis. Now, to understand how much time we have left in this silver bull market, I track 4 key indicators that have historically signaled when the top is near. And I want to walk you through each of these indicators right now so you can track them yourself and make informed decisions about your own silver holdings. The first indicator I track is the gold to silver ratio, and this is probably the single most important indicator for understanding where we are in the silver cycle. For those of you who are new to this channel, the gold to silver ratio simply tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio averages around 60 to 1. But during major silver bull markets, this ratio crashes dramatically. In 1980, the gold to silver ratio crashed all the way down to 17 to 1. In 2011, it crashed to about 32 to 1. And as I'm recording this video in January 2026, the gold to silver ratio is currently sitting around 52 to 1, down from a high of over 120 to 1 back in March 2020. This tells me something very important. We are clearly in the phase of the bull market where silver is outperforming gold, which is exactly what happens in the late stages of every precious metals bull market. But here's the thing. We haven't reached the extreme levels that have historically marked the top. If the gold to silver ratio needs to reach at least 32 to 1 like it did in 2011, or even lower like the 17 to 1 we saw in 1980, that suggests silver still has significant outperformance ahead of it relative to gold. At current gold prices of around $4,800 per ounce, a gold to silver ratio of 32 to 1 would put silver at $150 per ounce. And a ratio of 17 to 1 would put silver at over $280 per ounce. So based on this first indicator alone, I believe we are not yet at the top. We're getting closer, but we're not there yet. And this is why I'm continuing to hold my silver position and even adding on significant pullbacks. The second indicator I track is the US dollar index, also known as the DXY. And this is where things get really interesting because historically, silver bull markets don't reach their final peak until the US dollar has experienced a significant decline. In the late 1970s, the DXY crashed nearly 30%, leading into the 1980 silver peak. In the late 2000s, the DXY crashed over 40%, leading into the 2011 peak. Now, as of today in January 2026, the DXY has declined about 22% from its 2022 highs. This is significant, but it's not yet at the levels we've seen at previous silver market tops. If history is any guide, the dollar still has room to fall, potentially another 10 to 15% from current levels before silver reaches its ultimate peak in this cycle. And with the Federal Reserve continuing to cut interest rates and the US government continuing to run massive deficits, I see no reason why the dollar weakness should stop here. The third indicator I track is real interest rates, and this is something that most silver investors don't pay enough attention to. Real interest rates are calculated by taking the nominal interest rate and subtracting inflation. When real interest rates are positive, it means you're actually earning money by holding cash or bonds after accounting for inflation. When real interest rates are negative, it means you're losing purchasing power by holding cash or bonds. Historically, precious metals bull markets thrive when real interest rates are negative, and they typically don't end until real interest rates turn significantly positive. Looking at the current situation in January 2026, real interest rates are still deeply negative. The Federal Reserve's target rate is around 3.5%, but inflation as measured by CPI is running at nearly 6%. That means real interest rates are negative 2.5%. Until we see real interest rates turn positive, which would require either significantly higher Fed rates or significantly lower inflation, I don't believe the silver bull market can end. And based on what I'm seeing from the Federal Reserve right now, with them talking about potential rate cuts later this year due to slowing economic growth, I think negative real interest rates are likely to persist for at least another 12 to 24 months. This supports my thesis that we have significant time left in this bull market. The fourth and final indicator I track is what I call the crisis indicator. And this is perhaps the most subjective of the four, but it's also historically the most powerful. Every major silver peak has coincided with or been preceded by some kind of financial crisis or major market event. In 1980, it was the Iranian hostage crisis and massive inflation fears. In 2011, it was the European debt crisis and fears of a global financial meltdown. Now, looking at the world today in January 2026, we have plenty of candidates for the next major crisis. Japan's debt situation continues to deteriorate with bond yields rising to levels that threaten the solvency of major Japanese banks and insurance companies. The U.S. commercial real estate market is still experiencing major stress, and global tensions continue to escalate on multiple fronts. But here's the thing. We haven't had that final crisis moment yet. That moment when fear reaches its absolute peak and everyone rushes into precious metals all at once. When that moment comes, and I believe it will come within the next 12 to 24 months, that's when we'll likely see silver's final parabolic spike. So to summarize these four indicators, the gold to silver ratio tells me we're getting closer, but not there yet. The dollar index tells me there's likely more downside ahead for the dollar, which means more upside for silver. Real interest rates tell me the fundamental conditions for this bull market remain firmly in place. And the crisis indicator tells me we haven't had that final fear spike that typically marks the absolute top. Based on all four of these indicators, my best estimate is that we have somewhere between 12 and 30 months left in the silver bull market. That would put the potential top somewhere between early 2027 and mid-2028. And given where silver is trading today around $95 per ounce, I believe we could see silver reach anywhere from $150 to $300 per ounce before this bull market finally ends. Now let's talk about what happens after the top. All right, so now we need to have a serious conversation about what happens when this silver bull market eventually ends. Because as I mentioned earlier, the crashes after the 1980 and 2011 tops were absolutely devastating for investors who weren't prepared. And I don't want anyone watching this channel to experience that kind of pain. Let's start by examining what happened after the 1980 peak in detail. Silver reached its all-time high of just under $50 per ounce on January 18, 1980. By March 27th of that same year, just 68 days later, silver had crashed to under $11 per ounce. That's a decline of nearly 78% in just over 2 months. Imagine holding $100,000 worth of silver and watching it turn into $22,000 in less than 70 days. That's exactly what happened to people who bought at the top without a plan. But it didn't stop there. After a brief recovery in late 1980 and early 1981, silver continued to decline for nearly 2 decades. By 1991, silver was trading under $4 per ounce, and it didn't make a sustained move higher until the early 2000s. That's 20 years of waiting for people who bought at the 1980 peak. 20 years of regret, 20 years of opportunity cost. Now let's look at what happened after the 2011 peak. Silver reached its high of just under $50 per ounce in late April 2011. Over the next week, silver crashed from $50 to under $35 per ounce. That's a 30% decline in just 1 week, and the bleeding didn't stop there. By mid-2011, silver was trading in the low 30s. By 2013, it had broken below $20. And by late 2015, silver had bottomed around $14 per ounce. That's a decline of over 70% from the peak, spread out over about 4.5 years. And for people who bought silver at $40 or $45 per ounce in early 2011, it took until 2020, nearly a decade later, for silver to recover those levels. Again, we're talking about a decade of waiting and regret. So why do these crashes happen? And more importantly, what can we learn from them to protect ourselves this time around? The crashes happen for several interconnected reasons. First, there's the simple reality of market psychology. Bull markets attract more and more buyers as prices rise. By the time a bull market reaches its peak, you have maximum participation from retail investors, speculators, and momentum chasers. These are often the least informed and most emotional participants in the market, and when the trend reverses, they panic and sell, creating a cascade of selling pressure that feeds on itself. Second, there's the leverage factor. During the late stages of bull markets, many investors use borrowed money to amplify their returns. This works great on the way up, but it's catastrophic on the way down. When prices start falling, leveraged investors get margin calls and are forced to sell regardless of the price. This forced selling accelerates the decline and creates the violent crashes we see at the end of bull markets. Third, there's the fundamental shift that often occurs at market tops. In 1980, the Federal Reserve under Paul Volcker raised interest rates to nearly 20% to crush inflation. This made holding non-yielding assets like silver much less attractive compared to suddenly high-yielding bonds. In 2011, the European debt crisis was eventually contained through central bank intervention, reducing the fear that had driven safe haven demand for metals. Understanding these dynamics is crucial for surviving the next crash. Because here's what I want you to understand. The crash is not something to fear if you're prepared for it. The crash is actually an opportunity to reposition your portfolio and potentially build even more wealth on the other side. But here's where this cycle might be different from 1980 and 2011, and this is something that I think most analysts are completely missing. In 1980, after silver crashed, there was plenty of silver available. The US government was selling its strategic silver stockpile. Industrial demand for silver was relatively low, and there were large above-ground stockpiles that could meet any surge in demand. This abundance of supply allowed prices to stay low for decades. In 2011, a similar situation existed. Silver was still in surplus most years, meaning more silver was being mined than was being consumed. There were still substantial above-ground stockpiles, and while industrial demand was growing, it wasn't yet at the critical levels we see today. But the situation in 2026 is fundamentally different, and this is the key insight I want you to take away from this video. Today, silver is in a structural deficit. For the past 6 consecutive years, more silver has been consumed than has been produced. Above-ground stockpiles at COMEX and the LBMA have been declining steadily. The United States has designated silver as a critical mineral for national security. China has implemented export restrictions on silver, and industrial demand for silver continues to grow exponentially due to solar panels, electric vehicles, electronics, and medical applications. This means that even if we get a significant price crash after this bull market ends, which I believe we will, the fundamental supply and demand dynamics may not allow silver to stay down for nearly as long as it did after 1980 or 2011. The world simply needs too much silver, and there isn't enough of it to go around at low prices anymore. This is why I believe the next crash, when it eventually comes, might look more like a 30 to 40% correction that lasts 6 to 18 months rather than a 70 to 80% crash that lasts a decade or more. And this has significant implications for how we should approach both the remainder of this bull market and the eventual aftermath. Let me explain exactly what I mean. Now, I know that saying "this time is different" is one of the most dangerous phrases in investing. Every time someone says it, they usually end up looking foolish. But I want to make a careful and specific argument for why the aftermath of this silver bull market might actually unfold differently than previous cycles. Let me start with the supply side of the equation. Global silver mine production peaked in 2016 at around 900 million ounces per year. Since then, production has been flat to declining, coming in at around 820 million ounces in 2025. This is despite silver prices rising dramatically over this period. In a normal commodity market, higher prices should incentivize more production. But silver is different because approximately 70% of silver is produced as a byproduct of mining other metals like copper, lead, and zinc. This means silver miners can't simply ramp up production in response to higher prices. They're constrained by the economics and production decisions of the primary metal they're mining. And with many of the world's largest copper and zinc mines aging and new projects taking 10 to 15 years to develop and bring online, there's no significant increase in silver supply coming anytime soon. On the demand side, the story is even more compelling. Let me give you some specific numbers that should make you very uncomfortable if you're thinking about selling your silver anytime soon. Solar panel demand for silver has grown from around 50 million ounces per year in 2014 to over 230 million ounces per year in 2025. That's a 360% increase in just 11 years. And the International Energy Agency projects that solar installations will need to triple from current levels by 2030 to meet global climate goals. If that happens, solar demand alone could consume over 600 million ounces of silver per year, which would be nearly 75% of total annual mine production. Electric vehicle demand for silver is also growing rapidly. Each electric vehicle uses approximately 25 to 50 grams of silver, compared to 15 to 28 grams for a traditional internal combustion engine vehicle. With EV production expected to grow from 14 million vehicles in 2025 to over 40 million vehicles by 2030, this represents another significant source of growing demand. Electronics demand continues to grow with every smartphone, computer, and connected device requiring small amounts of silver. Medical applications for silver are expanding due to its antibacterial properties, and 5G infrastructure requires significant amounts of silver for its conductivity properties. When you add all of this up, you get a demand picture that is fundamentally different from what existed in 1980 or 2011. The world is not just speculating on silver as a monetary metal or inflation hedge. The world actually needs silver as an essential industrial material, and there isn't enough of it to go around. Now let me talk about the above-ground stockpiles, because this is where things get really interesting. In 1980, the United States government held approximately 165 million ounces of silver in its strategic stockpile. This stockpile was gradually sold off over the following decades, adding supply to the market and helping to keep prices suppressed. Today, the U.S. government holds exactly 0 ounces of silver in strategic reserves. In fact, as I've mentioned in previous videos, I believe the U.S. government is now quietly accumulating silver for national security purposes, adding to demand rather than supply. COMEX registered silver inventory, which represents silver available for immediate delivery, has declined from over 150 million ounces in 2021 to under 40 million ounces today. LBMA vaulted silver has seen similar declines. And anecdotal reports from dealers and refiners suggest that physical silver is becoming increasingly difficult to source in large quantities. This is a fundamentally different supply and demand situation than existed after either of the previous 2 bull market peaks, and it's why I believe the aftermath of this bull market will look different as well. But don't misunderstand me, I'm not saying silver won't crash when this bull market ends. It absolutely will. Speculative excess will be purged, leveraged positions will be liquidated, weak hands will sell, and prices will decline sharply, at least in the short term. What I am saying is that the floor for silver prices after this bull market is likely to be much higher than it was after previous bull markets. In 1980, silver crashed from $50 to under $4 over the following decades. In 2011, silver crashed from $50 to around $14 over the following years. But in this cycle, I believe the floor for silver is likely to be somewhere between $60 and $80 per ounce. Why? Because that's approximately the marginal cost of production for many silver miners when you account for true all-in sustaining costs. And more importantly, that's the price level at which industrial consumers will likely step in aggressively to secure supply for their manufacturing needs. Think about it from the perspective of a solar panel manufacturer. If silver crashes from $200 per ounce to $70 per ounce, that represents a massive opportunity to lock in lower costs for a critical input material. These industrial buyers will provide a floor for prices that didn't exist in previous cycles because their demand is not discretionary. They need silver to make their products, regardless of whether speculators are buying or selling. This is why I'm approaching the eventual end of this bull market differently than I might have approached previous cycles. Instead of planning to sell everything near the top and wait years to buy back in, I'm planning to take some profits as we reach my target levels but maintain a core position in physical silver that I never sell. Because even after the crash, I believe silver will be worth multiples of today's price within the following decade as the structural supply deficit continues to compound. Let me now share my specific price targets and strategy for the remainder of this bull market. All right, so let's get specific about price targets because I know that's what many of you have been waiting for. Based on my analysis of the 4 indicators I shared earlier, combined with the supply and demand fundamentals I just discussed, here are the levels I'm watching for silver as this bull market plays out. My first major target for silver is $125 per ounce. This is what I consider a conservative target based on the current trajectory and the historical patterns I've analyzed. At $125 silver, the gold to silver ratio would be approximately 38 to 1, assuming gold is trading around $4,800 per ounce. This would be close to, but not quite at the levels we saw at the 2011 top. My second major target for silver is $175 per ounce. This is my base case target and represents what I believe is the most likely peak for this cycle if it plays out similarly to 2011. At this level, we would likely see the gold to silver ratio reach the low 30s, significant retail investor euphoria, and many of the classic signs of a market top. My third and most aggressive target for silver is $250 to $300 per ounce. This is my everything breaks scenario where we see a major financial crisis, loss of confidence in the US dollar, and a true flight to hard assets. At this level, the gold to silver ratio could potentially reach the high teens or low 20s like we saw in 1980. I consider this scenario to have maybe a 20 to 25% probability, but it's important to be prepared for it. Now, what's my strategy for navigating these levels? Let me share exactly what I'm planning to do, though of course this is not financial advice and everyone needs to make their own decisions based on their own circumstances. At $125 silver, I plan to sell approximately 15 to 20% of my silver holdings. This will allow me to recover my entire original investment while still maintaining significant exposure to further upside. This is what I call the play with house money level. At $175 silver, I plan to sell another 25 to 30% of my holdings. At this point, I will have locked in significant profits and will be holding roughly half of my original position essentially for free. At $250 or higher, if we get there, I plan to sell another 25% of my holdings. This would leave me with a core position of roughly 25 to 30% of my original holdings that I plan to hold through the crash and into the next cycle. Why am I keeping any silver at all if I think a crash is coming? 2 reasons. First, I've been in this market long enough to know that timing the exact top is essentially impossible. The market can stay irrational longer than you can stay solvent, as the saying goes. By scaling out in tranches rather than trying to sell everything at one point, I reduce the risk of selling too early and missing the final parabolic run. Second, as I explained in the previous section, I believe the floor for silver after this bull market is likely to be much higher than in previous cycles. If my analysis is correct and the post-crash floor is somewhere between $60 and $80 per ounce, then holding some silver through the crash and into the next cycle could still be highly profitable, especially when you consider that I originally accumulated much of my position at prices between $15 and $25 per ounce. Now let's get to this video's viewer question, and remember, I answer one viewer question in every video. All you have to do is submit your questions in the comments section below, and your question may appear in my next video. This week's question comes from a viewer who asks, what's the best way to buy physical silver right now for someone just starting out? This is a great question because I think many people are intimidated by the process of buying physical silver for the first time. Here's my advice. First, start with reputable dealers. I've linked my recommended dealer in the description below. Avoid random sellers on auction sites or social media unless you really know what you're doing. Second, for beginners, I recommend starting with government-minted coins like American Silver Eagles or Canadian Silver Maple Leafs. Yes, they carry slightly higher premiums than generic rounds or bars, but they're instantly recognizable and easy to sell when the time comes. Third, if you're buying larger quantities and want to minimize premiums, 10-ounce bars or 100-ounce bars from reputable mints are good options. Just understand that larger bars can be harder to sell in partial amounts if you only need to liquidate part of your position. Fourth, consider your storage situation before you buy. If you don't have a secure place to store physical silver, you might want to start small until you figure out your storage solution. And finally, dollar cost average rather than buying everything at once. Even though I'm bullish on silver, prices are volatile in the short term. Buying a little bit each month reduces your risk of buying everything right before a short-term pullback. All right, everyone. I think that covers everything I wanted to share with you in this video. Let me quickly summarize the key takeaways. First, based on historical patterns and my 4 key indicators, I believe we have somewhere between 12 and 30 months left in this silver bull market. Second, I expect silver to reach between $150 and $250 per ounce before this bull market ends, with an outside possibility of $300 or higher if we get a major financial crisis. Third, the crash after the bull market will likely be severe in percentage terms, but the floor will likely be higher than previous cycles due to structural supply deficits and strong industrial demand. Fourth, I'm planning to scale out of my position in tranches while maintaining a core holding that I'll carry into the next cycle. If you enjoyed this content, please remember to like this video as it helps the algorithm share this with more people who need to hear this message. If you have friends or family members who own silver or are thinking about buying, please share this video with them. It helps grow the finance currency community and gets this important information into more hands. I also want to remind everyone to take care of yourselves. These are volatile and uncertain times. It's easy to get caught up in the excitement of rising prices or the fear of potential crashes. But at the end of the day, your mental health and your relationships are more important than any investment. So please take care of yourselves, but more importantly, take care of each other. I'll see you all in the next video. Goodbye.